Hey, what's up everybody? It's SM and welcome back to the channel. Today we're diving into the world of trading and uncovering the 10 most common mistakes beginners make. So grab your notepad and pen and let's get started. Alright, let's kick things off with mistake number 1, not having a trading plan. This is like setting sail without a map or compass. You might eventually stumble upon your destination, but it's going to be a whole lot harder and riskier. A trading plan acts as your roadmap, outlining your financial goals, risk tolerance, preferred trading style, and the strategies you'll use to achieve your objectives. Without a plan, you're essentially shooting in the dark and hoping for the best. Trust me, that's not a recipe for success in the trading world. Think of it like this. Imagine you're building a house. Would you just start laying bricks without a blueprint? Of course not. You need a plan to guide your actions and ensure you're building a solid foundation. The same principle applies to trading. A well-defined trading plan helps you stay disciplined, manage risks, and make informed decisions, even when the market gets volatile. Are you looking for short-term gains or long-term growth? Next, determine your risk tolerance. How much are you willing to lose on a single trade? Once you have a clear understanding of your goals and risk appetite, you can start researching different trading strategies and identifying the ones that align with your objectives. Remember, your trading plan is a living document. Regularly review and adjust your plan based on your progress and market conditions. Moving on to mistake number 2, overtrading. This is a common pitfall for beginners who are eager to jump into the market and start making profits. Overtrading occurs when you're placing too many trades without proper analysis or consideration. It's like trying to swing at every pitch in baseball. You're bound to strike out eventually. Remember, trading is a marathon, not a sprint. It's about making calculated decisions and waiting for the right opportunities. Overtrading often leads to impulsive decisions, increased transaction costs, and ultimately diminished returns. Think of it like this. Imagine you're at a casino playing roulette. You wouldn't just bet on every single number, would you? No, you'd carefully analyze the odds, choose your bets strategically, and manage your bankroll wisely. To avoid overtrading, focus on quality over quantity. Remember, patience is key in trading. Let's talk about mistake number 3, not using stop-loss orders. This is like driving a car without brakes. You're setting yourself up for a potential disaster. A stop-loss order is an order that automatically sells your stock at a predetermined price, limiting your potential losses. Many beginners are hesitant to use stop-loss orders because they're afraid of missing out on potential profits. However, not using stop-loss orders is like playing with fire. It only takes one bad trade to wipe out your entire account. Think of it like this. Imagine you're investing in real estate. You wouldn't buy a property without first setting a budget, right? A stop-loss order acts as your budget in trading. It helps you control your risk and protect your capital. Moving on to mistake number 4, following the crowd. This is a classic case of if everyone's doing it, it must be right, which, as we all know, isn't always the case. In trading, following the crowd can be especially dangerous as it often leads to buying at the top and selling at the bottom. Remember, the market is driven by fear and greed. When everyone is bullish, it's usually a sign that the market is overbought and due for a correction. Conversely, when everyone is bearish, it could be a sign that the market is oversold and presenting a buying opportunity. Think of it like this. Imagine you're at a concert and everyone starts running towards the exit. You don't know what's going on, but you start running too because everyone else is. Instead of blindly following the herd, do your own research and analysis. Remember, contrarian thinking can be your best friend in trading. Let's talk about mistake number 5, lack of research and analysis. This is like going into a job interview without preparing. You're setting yourself up for failure. Before you even think about placing a trade, it's crucial to conduct thorough research and analysis to understand the underlying fundamentals of the company or asset you're interested in. This includes analyzing financial statements, understanding industry trends, and evaluating the company's management team. By doing your homework, you'll be able to make more informed trading decisions and increase your chances of success. Think of it like this. Imagine you're a detective investigating a crime. You wouldn't just arrest the first person you see, would you? No, you'd gather evidence, interview witnesses, and analyze the facts before making an arrest. The same principle applies to trading. Moving on to mistake number 6, emotional trading. This is one of the biggest pitfalls for beginners and experienced traders alike. Emotional trading occurs when you let your emotions, such as fear or greed, dictate your trading decisions. When you trade based on emotions, you're more likely to make impulsive decisions that you later regret. Fear can cause you to sell too early, while greed can lead you to hold on to a losing trade for too long. Think of it like this. Imagine you're playing poker. You have a great hand, but you start to get nervous and second-guess yourself. You end up folding only to find out later that you would have won the pot. To avoid emotional trading, it's essential to have a solid trading plan and stick to it. Remember, trading is a game of logic and strategy, not emotions. Let's talk about mistake number 7, poor risk management. This is like going skydiving without a parachute. You're putting your entire account at risk. Risk management is all about protecting your capital and minimizing your losses. One of the most important aspects of risk management is determining your risk tolerance. How much are you willing to lose on a single trade? Once you know your risk tolerance, you can set appropriate position sizes and stop-loss orders. Think of it like this. Imagine you're a general leading an army into battle. You wouldn't send all your troops to the front lines, would you? No, you'd strategically position your troops to minimize casualties. The same principle applies to trading. Another important aspect of risk management is diversification. Don't put all your eggs in one basket. Moving on to mistake number 8. Lack of diversification. This is like putting all your money into one stock and hoping for the best. It's a recipe for disaster. Diversification is the practice of spreading your investments across different asset classes, sectors, and geographies to reduce your overall risk. By diversifying your portfolio, you're essentially hedging your bets. If one investment performs poorly, the others can help offset those losses. Remember, don't put all your eggs in one basket. Think of it like this. Imagine you're building a house. You wouldn't build it on just one pillar, would you? No, you'd build it on a solid foundation with multiple pillars to provide stability and support. The same principle applies to investing. You can invest in different asset classes, such as stocks, bonds, and real estate. Let's talk about mistake number 9, trading without a strategy. This is like going on a road trip without a map or GPS. You're likely to get lost and waste a lot of time and money. A trading strategy is a set of rules that guide your trading decisions, helping you identify entry and exit points, manage risk, and maximize profits. Without a strategy, you're essentially trading on gut feeling, which is a recipe for disaster. A well-defined trading strategy should be based on thorough research, back-testing, and analysis. Think of it like this. Imagine you're a chef preparing a new dish. You wouldn't just throw random ingredients together and hope for the best, would you? No, you'd follow a recipe, measure ingredients carefully, and taste test along the way. The same principle applies to trading. Finally, let's talk about mistake number 10, not continuously learning. The world of trading is constantly evolving, so it's crucial to stay ahead of the curve and continuously educate yourself. This includes staying up to date on market trends, learning new trading strategies, and attending industry events. The more you learn, the better equipped you'll be to navigate the markets and make profitable trades. Think of it like this. Imagine you're a doctor. You wouldn't just stop learning after medical school, would you? No, you'd attend conferences, read medical journals, and stay abreast of the latest advancements in medicine. The same principle applies to trading. There are countless resources available to help you continue your trading education, including books, online courses, and webinars. That's it for the 10 most common trading mistakes beginners make. I hope you found this video helpful. Remember, trading can be a rewarding endeavor, but it's important to approach it with caution and a solid understanding of the risks involved. If you found this video helpful, make sure to give it a thumbs up and subscribe to the channel for more trading tips and insights. Until next time, happy trading!